So the big question is this: how do investors like us who trade options and manage our own money generate income regardless of where the stock market goes, and do it all in a way that lets us make time for the people and things we love, and yet still build wealth and remain profitable? That's the question, and this podcast will give you the answer. I'm your host, Kirk Duplessis, and you're listening to The Daily Call from Option Alpha. Hey everyone, this is Kirk here again from Option Alpha, and welcome back to The Daily Call. Today we're going to be answering a user question, a member question, which is what happens to deep in the money option spreads at expiration. So the question really comes out of this idea of, well, if I have a spread and the spread is deep in the money, let's say I've sold a call spread and the stock has rallied well beyond my call spread strikes, both the short strike and the long strike. If I let it go to expiration, what happens? And so if you do let the spread go all the way to expiration and then go through the expiration process, you will be assigned on your short option contracts, and the broker will assume automatic exercise of your long option contracts. Now, this should result in basically no stock to you at the end of the day, because you are assigned stock on one end and you are, let's say, buying stock on the other end. And so that should equal each other out. As long as you have the same number of contracts, it should net out to no additional stock to you, but you will be out, obviously, the commissions that went with the assignment and expiration or exercise of those contracts. So it is always in your best interest, in our opinion, to close out of your spreads, even if they're deep in the money at expiration, and buy back those spreads either at or maybe even a penny above their full value. And the reason that we sometimes would buy a spread back for a penny above its full value is because paying an extra $1 to close out of the position, even if our max spread is $3, we might pay $3.01, is much cheaper than paying, let's say, a $15 or $20 assignment or exercise fee to the brokers to let it go through expiration. So the $1 is much cheaper just to remove the position and exit the trade than to let it go through the expiration process. So hopefully this helps out. As always, if you guys have any questions like this, let me know. Until next time, happy trading. Thanks for joining us on The Daily Call. Be sure to subscribe right now for more daily options trading ideas, strategies, and tactics to help you learn how to place smarter, more profitable trades. And if you like what we're doing, don't forget to give us a rating and a review so we can continue to bring you the best daily content possible. We'll see you again tomorrow, right here on The Daily Call from OptionAlpha.com.